Now, the RBI in its commentary on the external sector has said that the financing of the current account deficit is going to pose a challenge as long as the global situation remains uncertain. But do you believe that is so much a concern given all the excess liquidity that's lying around in Europe, the US, all of that looking to come into emerging markets? Do you believe in the near term flows are a concern and that the CAD should be a worry for us?
I would put it this way, yes, the current account deficit will continue to be something which will keep on haunting us, because on a running basis, you are running in a country with about $25 billion of monthly exports and about $40 billion of monthly imports. So like it or not, the mathematical number tells you that you have $15 billion running negative. As against that, so when you annualize that, that comes to about $200 billion to $25 billion. As against that, the very visible number that we all track, which is the FII inflows, is running at, in the last 2 months, we had $7 billion, including one big ticket investment, but otherwise we've been running at an annualized $25 billion. So while it has a lot of seasonality, and the liquidity, as you judge, you clearly said there is clearly enough liquidity available in the markets. But I would probably look at it this way, that the US market is already showing an uptick in the interest rates. The Eurozone is sloshing with liquidity, with banks placing the money out there. And many people have said that the Indian fundamentals have not grossly changed, but there's a lot of money that's come in, so it's liquidity chasing emerging markets. So I don't know whether this is sustainable. Now, when you look at it from an oil point of view, and you see last year's average oil price, say, at about $95, and this year, depending on how it pans out, say, at 125, that is going to be a large one. And it's not just the oil, as much as if rupee again goes back and tests those 54, 55 levels, then you're going to be importing in a lot of inflation. So sometimes I also think that the answer to your question is also in that we have a liquidity problem, we have an inflation problem, and we have a current account deficit. So maybe internally there's not so much of liquidity available, and maybe the answer therefore lies in probably opening up the overseas taps, even selectively the ECB for infrastructure, making the NRA deposits much more attractive, so that it becomes a kind of mimic of the earlier resurgent India bonds or the India Millennium bonds, because that is the way the rupee will strengthen, that is the way the reserves will go up, that is the way the liquidity will increase, and that's the way the money can be directed towards select sectors like infrastructure or real estate.
Sure. So, Hari, you're clearly saying that the CAD remains a concern. So, in light of that, do you believe we could possibly see the rupee go to levels that we saw in November once again?
Directionally, yes. If you see the dollar index, it's already gone above 80. So it's not just a rupee versus a dollar, as much as the dollar has been going up against overseas currencies. Again, reflecting fundamentals that the US market seems to have taken a lot of medicine well ahead of the others, and therefore is enjoying the strength that comes with having taken the medicine earlier. So given that, and given the fact that post today's credit policy, you'll also see a little bit of softness in the market. And tomorrow, while we are all going to be watching the budgets very carefully, I think the room for maneuvering is very limited. On the positive, if you are going to forecast a higher revenue, and you're going to forecast a higher disinvestment and a higher telecom revenue, you also have on the expenditure side a lot of infrastructure spend that has to happen if you got to kickstart growth in the economy. You have the food security bill, which is standing by. Now, if it's just an aggregation of various other programs, the amount may not be large, but if it's a genuine new program, then the amount can be large. But most importantly, the toss between how much of diesel and petrol price hike you're going to take on the road and take inflation on the chin, or how much of it you're going to absorb in the fisc and pass it on as a government borrowing program. So looking at all of that, you're going to have a little bit of softness coming in the stock market, which will reflect on the rupee. And then you have the corporate sector. If it's not covered, its sector, it's exposures completely. You could have swings which need not necessarily be a fundamental swing, but will be momentary swings, like it happened in November.
Yields on the 10-year bond have been ruling firm at that level of 8.3%. Do you see them in the future course going down, and on what factors do you believe that will be contingent on?
The space for the yields to go down is not very much. They can probably go down a little bit in April or May, as the other panelists have said, when inflation may go down a little bit and offer a window to the RBI to cut the rates. It could also be a same time when you're going to have about 75-80,000 crores of redemptions happening in the first couple of months. So in case the RBI, when they make out their calendar, in case they decide to rear-end the borrowing calendar and let the money stay in the market, it will work very good in the sense that the yields will start coming off, and there could be a reduction in the liquidity shortage in the marketplace. It will work very well from a sentiment point of view, but it will put the risk of the entire borrowing getting on to the next 9 months, and that can cause a bit of a stress. So The yields may go down a little bit, but I think the space for the yields to go down is going to be very limited, considering that more likely they're not looking at the reaction to the railway budget that's been happening from yesterday and today. The amount of ability to pass through the crude price hikes may be fairly limited, and in that case, the fisc is going to take most of the strain. And in a system which is already running at about 29% maintenance of SLR, you're going to have at least about 5.5 lakh crore coming in. Now, if I take the interest and the redemptions that are happening, they are roughly about 2 lakh crores. So you still are going to have 3 lakh crores of net supply coming into the marketplace in a market which is already running surplus. So the ability for the yields to go down may be a bit less, and the market will be more concerned with the amount of liquidity available rather than necessarily the yields.